Today I have Greg from Blackfox Property with me. Greg, welcome. Thanks for being
Thank
with
you.
us.
Thank you for having me.
I want to talk to you a little bit today about where you're investing in terms of where you're allocating capital, and also this perhaps changing shift between private credit towards private equity. But paint a picture for us as to kind of where you think we are in that cycle and how the most recent interest rate move by the RBA is perhaps starting to shift the market back towards the equity space.
Yeah, sure. So Blackfox Property is a private equity fund manager. We buy assets on behalf of high net worth individuals, family offices, or wealth managers and syndicate them into equity investments. But I would say our number one competition is the non-bank lending or debt space, because investors in that market can get a pretty stable return and not take on equity-like risk. The benefit of equity is you get the upside. The disadvantage is you obviously share the downside risk as well. But I think to your point earlier is the non-bank lending space in Australia is really small compared to many other global markets. The US probably has a major part of their bank lending space in the non-bank lending sector, whereas Australia is very small. And the reason why we've seen a huge explosion in the amount of players in that space is purely because we haven't offered that product to the market for a long time. And so over the last 5 years, you've seen an enormous amount of entrants come into the market to compete with bank lenders who are much more conservative and risk averse versus non-bank lending players who are prepared to take on more risk, but looking for those stable cash flows. I think that what you've seen over the last 5 years is interest rates or increase. We've increased by 3 times, and the non-bank lending space being the beneficiary of that. We've seen a huge amount of transactions happen in the space, and the returns for non-bank lending products have been circa 10 to 12% with limited risk. And when I say limited risk is we have investors say to us all the time that we can get 8 to 10% for a debt product and it's risk-free. And I would just caution investors to say no investment is risk-free.
Yep.
Non-bank lending, whilst the risk is different, risk still exists that you're investing in the debt sleeve of a product and the product value can still fall over time. Now, you've got a bit of cushioning in that because the underlying debt provider or debt investor has a 30 to 35% buffer. But we've seen valuations in the last 6 to 12 months fall by 50 or 75% depending on the product. And so in the credit space, you've seen an enormous amount of capital chasing that, looking for 8 to 12% returns with limited risk. And in the equity space, we've seen capital shy away from that market over the last 3 to 5 years purely because interest rates have risen and there's less demand in that market.
The issue I have with private credit is not necessarily the strategy, but the mispricing of risk. And at the end of the day, as a debt investor, I get a coupon, but I don't necessarily share in the upside. And if that coupon's not priced right for the balance sheet and lending exposure that I'm getting, you can really get it wrong, right? With operating leverage and everything else. Before we get into equity and how equity is changing and looking more attractive, tell me a little bit about where you think the current state of the debt market is. Do you think risk is being adequately priced? And if not, how bad is it and how bad can it be over the next few years?
I like to use the scenario that we're a small player in the non-bank lending or credit space, and we've grown exponentially over the last 3 years. And so if there is more demand chasing deals and the hurdles haven't changed, you've got to be much more open to taking deals on that may have more risk, but the same returns. And so no disrespect to the credit market, because there's still some fantastic players in that space that really assess risk well. But what you're starting to see unfold, particularly in the last 12 months, is credit players are prepared to take on more risk and misprice risk in order to get the same return because there's so much competition. And so we're starting to see development risk come into play. In the most media outlets over the last 6 months, you've seen many bad cases where development deals have gone south.
Yep.
And debt providers who our investors turn and say it's risk-free have seen the risk.
Yeah.
They've taken over the asset. The asset is not worth nearly what the price was, and investors have lost a lot of money.
And the temptation is to go into construction development because they're the ones with the juicier fees, the bigger the transaction sizes. I guess there's more deals out there, but they're the ones where if the tide turns, you really get caught out, right?
Well, as a lender, you put the lending hat on. If I could borrow from a bank, I would. Your margins are 125 basis points to 200 basis points, and terms are pretty straightforward. It's when you can't borrow from the bank, you start to look at the non-bank lending space. And even in that space, if you've got a deal that's relatively straightforward, you're talking about 7 to 8% as a coupon. Now, investors, if I go to them and say I can get you a deal for 6 to 7% net of fees, that's not really attractive. And so in order to get to the 10 to 12% returns, I'd say 9 to 12 is probably where they sit. You have to either take on a higher LVR or you've got to take on development risk.
Yeah.
Now, in the last 3 years, you've seen construction costs increase almost 2.5 times.
Yep.
And you've seen pre-sales come off for a lot of resi deals significantly. And so you've almost got a perfect storm where your construction costs have gone up significantly, pre-sales are not being met, and valuations are falling. That's the perfect storm where a development deal, the developer turns and says, I'm out, I'm making no money on this, take the keys. And then you've got to pray that you've invested in a non-bank lender that has experience to take over an asset. We haven't seen that in Australia. The reason why most investors say non-bank lending is risk-free is because for the last 5 or 6 years, you've given money to a non-bank lender and you've got your coupon at the end. And where there's been experiences where you haven't and you've got penalty interest, that's been to the advantage of the investor. What we're starting to see now is defaulting, taking over assets and working out assets.
And that's very difficult to take over a failed development, particularly if it's gone to market or started construction. It's very different to taking over a passive asset like a medical center.
Of course.
Or,
yeah.
You know.
And so a good example is we've got some of our investors who invest in equity and debt, which most investors do and should. It's good to spread risk. The investor invested in a great site in the eastern suburbs of Sydney. It was a development site and all the metrics made perfect sense. But what ended up happening is they started digging the site, put pylons in, and the developer went under.
Yeah.
That got taken over by the non-bank lender. That site, no one could do anything with. The value of that site was 60 to 70% lower than what was the true valuation of that site, because in order to make anything on that site, you needed to get another builder in.
Yeah.
A builder taking over another builder's job is incredibly hard. And you needed to work the project out for probably 2 or 3 years before anyone saw any capital back. Now, we don't see too much of that, but you're starting to see the writing on the walls in the non-bank lending space that the risk profile is changing.
I think we've done a really good job there highlighting the risks around credit. Back to equity, I remember it was a few years ago where equity deals were becoming more and more difficult because the yields were compressing. We were in a low interest rate environment. The excuse was the value is no longer in equity. And with rising interest rates, that's the bright side. Let's move away from the dark side.
Well, so to paint the picture on equity in 2021, which is probably where the peak of the market was, you would look at deals and you would probably be outbid by someone that would do no due diligence on the deal, that could get debt with no backing or no recourse at all, and could buy the asset at incredibly tight cap rates. And that was the scene because there was so much capital chasing opportunity. Fast forward to where we are now, and you've got institutional players in the market not present. So most institutional players are net sellers instead of buyers. You've got debt not being able to easily being accessed. So if you're looking for a property, whereas you may have got 60 to 70% debt in a deal and had to get 30% equity, banks are being very cautious. And so the demand supply fundamentals have changed. But also on top of that, you've seen valuations come back anywhere from 10 to 30% across sectors. I'd put office separate. Office has been bifurcated between Sydney, Melbourne, and I guess Brisbane, which has been probably the success story. But across the board, equities markets have gone through the roof. We've seen a run like no other.
Yeah.
Debt markets continue to deliver that coupon that you said, although there's so much more competition in that market. And equities markets have gone backwards, or if not stayed the same.
So if 2021 was the peak of equity, do you think we're at the trough now? Are we near it? Have we turned? Or are we still on the bottom?
I think we're still on the bottom. We're starting to see green shoots. The interest rate reduction was a good point, a good step in the right direction, albeit when you're listening to the RBA talk about all the key messages behind why that happened and whether future interest rates will happen as quickly as we would have liked. I think the messaging is they were pushed into making that decision.
Mm-hmm.
There is stress in the market. We're not seeing forced sales in the market, but we're definitely seeing vendors holding on as long as they can until they need to sell. The assets that we have bought have been either distressed sales or opportunistic buyers from our perspective, where 12, 18 months ago, maybe even 2 years ago, there would have been another 100 or 150 basis points on the cap rate than there is now. And purely because there just isn't much demand for equity chasing deals. I've made mistakes in the past when everyone starts talking about a sector, you jump on the bandwagon, and that's probably the worst time to get in because you're paying top prices and you're taking on all the risk.
Yep.
I think we're at a point in the equity cycle now where valuations are lower and there is less demand and you can make some really attractive returns.
Back to the actual assets that are coming up on your radar, give us a little bit of an idea geographically, type of asset, deal size, income source. Let's dig in a little bit into the mandate.
Maybe setting the scene, our investors are typically high net worth, ultra high net worth investors in two camps. One, retired and chasing yield, which is why debt has been attractive for them for so long, or have significant capital and are looking for value add returns. I think in the first camp, what you're seeing now is core sectors like retail, office, and large format retail delivering really stable cash flows at attractive pricing. And so you're still seeing things like childcare and neighborhood shopping centers trading at early 5s to 5.75% yields, which is still very tight, and we haven't seen that expand. But you're seeing opportunities for larger retail outlets or large format retail where you can buy them at really attractive cash yields. And so we look at opportunities where there is either 100% occupancy from a retail perspective, or you've got tenants in there for a long period of time where rents are lower than what market is. We'll come in and we'll assess the asset based on where rents are sitting and where market is, and we'll buy the asset with the hope to value add, drive the outcome by increasing the rents over time. And we've had some real success over the last 12 months in doing exactly that. A good example is maybe just finishing that off is you mentioned which markets we look at. I think we're agnostic to where we are. Opportunistic, I think you've got to be across all markets and there's opportunities in every market. But you want to invest in markets with strong population growth, strong income growth, and infrastructure investment. And the reason I say those three key things is because the fundamentals of property are driven by those things. So I know from my experience over my career working at institutional players like AMP Capital and Lend-Lease, and now my own business, Blackfox Property, is if you have those tailwinds behind you, it will drive rental growth and therefore drive valuations.
Yeah.
And so we did a deal last year, a distressed seller in Victoria owned a large format retail site anchored by Officeworks. It was 4 tenants in there, Officeworks, Metcash, which was a liquor store, Red Rooster, and a gym. We looked at that and thought all 4 of those tenants are under rented.
Yep.
We can drive rental growth. Again, driving rental growth is a low risk strategy compared to development risk.
Yep.
And we can deliver outsized returns for investors. And so we went to investors and said, we've got a deal on the table. It'll deliver an 8% cash yield. We pay monthly and a forecast or target IRR of 15% over a 5-year term. Stepped into that asset, drove actively drove a reduction in outgoings, reduced it by 50%, and replaced a tenant, the gym, which was paying $90 a square meter, with a new tenant at $250 a square meter. Now, my view in a market now is if you can drive returns without taking on development risk, you have far better risk-adjusted returns than taking on development. And an investor that invests in debt and gets an 8% coupon, or invests in an equity deal, which you're only taking on leasing risk and getting an 8% coupon, but
Definitely.
you share in the upside, is much more exciting.
How difficult is that kind of deal to replicate in Sydney?
Sydney, Metro Sydney is really hard. We actually think Sydney is still an overpriced market, and yields are very tight. But I think it's about having the experience, having the relationships in the market, and seeing mispricing. And so we own assets in major regional markets, as well as Sydney and Melbourne, and Brisbane as well. But typically we would buy an asset, we would know that there's a tenant that's paying under, and we have relationships with tenants that would potentially replace them. Mm-hmm. And so in that example that I said, it was a gym, which in my view is the covenant of a gym is not fantastic.
Yeah.
I knew Pet Barn. I've got a relationship with Pet Barn. I put that deal together and said to Pet Barn, you're not in that market. You need to be there. I know that they will pay fair market rent on that site, and put the deal together.
You mentioned the regions. Is there any regional area at the moment that kind of looks attractive to you, that is maybe overlooked, that is showing good value? Because we always talk about the major cities, but there's a lot more going on in Australia outside of the major hubs.
Yeah,
right?
Sure. We need to listen to our investors. And so our investors are saying we want yield. Mm-hmm. The market's saying we want yield, which is why debt is so attractive. You can't get yield in major Sydney metro area, and probably Melbourne as well. Brisbane maybe is a little bit easier. But three key markets that we've played in, and we've seen this thematic unfold for a long period of time, is Newcastle. Newcastle, heavily coal-based market, but we're now seeing that very much diversify away from coal and becoming in healthcare, education, a very diversified market. And because of COVID, more and more people have moved or migrated into places like Newcastle, which are much more affordable. So we like Newcastle. We own a number of assets in large format retail and industrial in Newcastle, and are big believers in that market. Another one is in Victoria, Shepparton. Again, what we look for is a top 5 regional market in Australia. Mm-hmm. The population has to, for us, be 100,000 people plus, sizable enough that if there is income risk or leasing risk, that there is other tenant demand in that market. Mm-hmm. But also going back to what I said earlier, income growth, population growth, and infrastructure investment. So Shepparton, major infrastructure investment in that market we've seen over the last 10 years. And it's a connection from Melbourne, Sydney, Brisbane. And then the last one, which I'm a big fan of, is in Toowoomba, second largest inland town after Canberra. Very wealthy catchment. There's thousands of new homes being built there, a $1.5 billion new hospital being built there, and vacancy, what we look for in retail in that market, is almost zero.
Greg, last question. What have you learnt about yourself as a leader building your business? And also overlaid with that, what have you learnt about yourself as an investor? Yeah,
sure. I've had investors across the spectrum: large pension funds, sovereign funds, institutional investors, and high net worth investors. And something I pride myself on is listening to what investors want and making sure that they understand the risk when investing. I think you can see across the market is there's fantastic fund managers in the market, both in the debt side and the equity side. What you really want is a manager that adequately assesses risk, mm-hmm. and then is transparent around communicating that risk. So something I pride myself on, and I've learned over my career, is always be transparent on when things are good and when things are not good. Mm-hmm. You communicate always to investors, and you tell them when things go wrong.
Yep.
But you also give strategies on how you can get around it.
Owning the mistakes.
Exactly. And that's my view is, as a fund manager, I will be just as good as every other fund manager in the market. I can't pretend to be any better or worse than anyone else. But as a person, my investors' money is so important. And the risk of losing $1 of investors' money I lose sleep at night thinking about that. But being transparent around where risk is, and when things go wrong, how we're going to fix it is really important. And we've pulled out of deals, lost money ourselves, purely because the risk profile just wasn't what we communicated to investors.
Awesome. Well, thank you very much. We wish you all the best this year.
Thank you.
Thank you for sharing your insights. And hopefully we can get you back to get a bit of a market update maybe mid-year.
Yeah, sure. Thank you for having me.
Thank you.